Hello and welcome to Options in Plain English. Today we're going to be talking about maybe the most widely used type of options configuration there is, the vertical spread. And in particular, today we're going to focus on debit spreads, long call spreads, and long put spreads. A vertical spread is a very versatile options tool because it allows you to clearly define max profit and max loss on top of reducing the initial debit to put on a position, even allowing you to trade very expensive underlyings which you wouldn't have access to otherwise. We're going to start by looking at a long call, which is a position that you already know. Where you buy a call, you have the potential for unlimited profits. You usually buy it out of the money, where the underlying price is currently here. So you buy it out of the money, and you have the potential, like I said, to make an unlimited amount in profit. Now, what's the drawback or the disadvantage for this position is that if it expires out of the money, then it's going to expire worthless. So you're risking the money that you paid for the call, which is the initial premium. As time starts passing, you're going to start suffering the loss of value. Every day is going to start decaying. This is called time decay and is measured by a Greek called theta. The other side of the coin is a short call, where you sell a call, usually out of the money. Then you get to keep the premium that you receive, and if it expires out of the money, you keep it as profit, but you are exposed to the risk of the underlying going higher and having potential unlimited losses on the upside. Now, if you combine those, well, what if you could buy this call and then sell a call that's going to be at a strike price that's higher than the call that you sold? That way, you're going to have this premium that you receive for the short call helping you mitigate the initial cost of the long call, and you're going to be giving up any profit that is above the strike price of the short call. Then, if you mentally combine the lines here, the profit and loss lines, what you're going to have is you're going to have less of an initial cost, and then once the price starts hitting the long call, it's going to start going up, and then once it hits the short call, it's going to stabilize because this profit is going to be offset by the loss here. So altogether, they're going to make a perfectly horizontal line in terms of P&L. So combining those two legs, you would have a long call spread, which is the position that we're going to look at here. This position consists of a long call at a strike price KL and a short call at a strike price KS. Now, remember, this is a position in itself, so don't think of this position as two components. You need to know that that's what this position is made up of, but you have to look at it as one strategy or one position. Okay, so you buy this call here on top of the line, and then you sell this call. So initially, you're going to have a premium that you have to pay, which could be a potential loss if it expires out of the money. But this is going to be less than if you had only bought this call. Now, in exchange for that mitigation of your initial investment, your initial premium that you pay, you're going to be sacrificing any profit that's above the call where you sold the short call. So as you can see here, price is here. This is the underlying price at expiration. Once it hits the long call, it starts going higher. And then once it hits the short call, then it stops going higher or lower. Now it's going to be constant. So you have a max profit here and a max loss. They are clearly defined. And this is one of the characteristics of vertical spreads. It is that they're not open-ended. You know exactly how much you're putting in. You know exactly your max profit, and you know exactly your max loss. So this makes these strategies ideal for people with limited capital, because you know that it's not going to get out of control. Also, you could think that in that case you could just buy calls or buy puts, and yes, you could do that, but like I said, you're going to have to make a bigger investment. At some point, there's going to be some underlyings where the calls are going to be so expensive that you can't afford to buy a call, but you could afford to buy a call spread. So let's go through all the elements here. You have a long call at strike price KL. You have a short call at strike price KS. You're going to be putting this on for a debit. This is your initial investment, and that's going to be your max loss. You can only lose what you put in, okay? So your max loss is CL minus CS. So whatever you paid for the call minus whatever you received for the short call. That's going to be your max loss, okay? Now, in terms of max profit, this can profit. The distance between strikes is going to be this, represented by this P&L line, and that's going to be the full value that this spread can have at expiration at any point at KS and above. That's going to be the max value, but you have to subtract the amount that you had to pay initially. So the max profit is going to be the difference in strike prices, KS minus KL, minus whatever it is you paid for your spread initially, CL minus CS. That would be your max profit. So if this width of the spread is $5 and you initially paid $3, then you can lose $3, but this can go to 5. So minus the 3 that you initially put in, you're going to be looking at a max profit of $2. So for a vertical spread, it's very clear, very defined, and this is why they're very nice strategies, especially, like I said, for people with limited capital. But even if you don't have any constraint in terms of capital, it would allow you to put on more positions, and it will allow you to diversify in a much better way, because you have to put on so little capital for each one of these positions, and you are taking a directional position here on your underlying. So it's a way to put something on, putting up really not that much capital. The break even here is the point where you go from making money to losing money, where you are flat. This would be the initial strike price, so the strike price where you bought your long, plus whatever it is that you paid for the spread, so the max loss or the cost of the spread. So KL plus the difference between CL minus CS. Now this would be the solid line. This would be the profit and loss at expiration, and this dash line represents any time prior to expiration. So this is going to be a curve that's going to start like this, not very close to the solid line, and with time passing is going to start approaching the expiration line every time more and more, until at expiration this is your profit and loss, depending on where the underlying ended up at. Again, the structure is long one out of the money call at KL and short one out of the money call at KS. Both of them together, that would be a long call spread. So to summarize, a long call spread is initiated for a debit on a single transaction. It has to be the same expiration and the same number of contracts. So if you're buying 3 long calls, then you have to sell 3 short calls, and that would be a long call spread times 3. So 3 call spreads, but always the same number of contracts on the long side and on the short side, and they have to be on the same expiration. Otherwise, it would be something completely different. It's a bullish position, as you can tell. The price is here. You need the stock to move all the way to the break even and higher for you to make money. So you want the price to go higher. This is a bullish position. It is closed with a sell to close order on a single transaction. So once you put it on a single transaction, once it reaches the value that you want, say for example, you put it on for $1, so $100 altogether, and it goes to 3 and you want to close it, then what you do is you just issue a sell to close order for your vertical spread, and in a single transaction, you're going to close your whole position. You could alternatively, you could also close the individual legs, but then you would be migrating from a strategy to a different strategy. So for example, if you get rid of the short leg here, then you would no longer have a long call spread. You would have a long call only, and then you'd be looking at a different strategy. The way we're looking at this is one single strategy comes in, it initiates, it starts as a spread, and it comes out as a spread. It's closed like a spread. The Greeks will be partially offset because of both legs. So if you have delta here, for example, this long call, let's say this one has a delta of 30. Then when you put on a position that's only a long call, you're going to have 30 long deltas. Now, if you initiate a long call spread, then you're going to have maybe 30 here and maybe 20 here. Then your total delta is going to be 30 minus 20. So 10 deltas only. So you are partially offsetting your delta. And the same thing is going to happen to the other Greeks, some of which we haven't seen yet. But just so you know, for now, also gamma and also vega and theta are going to be partially offset by having a vertical spread. At expiration, the whole spread, if it expires out of the money, it'll be worthless and you are going to have your whole investment as a loss. If it's at the money, and for a spread, being at the money means that the price is here in between, so there's going to be one in the money and another one out of the money. Then if you let it expire, you're going to be exercised on your long call, okay? So if you don't close it and you reach expiration and the price is at the money, so in between these two strikes at any point in here, then your long call is going to be exercised and you're going to take possession of however many shares you were covering with your spread. So it's important for you to close your position if you don't want to have this happen to you. Now, maybe that's part of your strategy, and if so, then yeah, you can just get the shares and keep them in your account. But if you don't, it is advisable to close your spread prior to expiration. Okay. Now, if it expires fully in the money, it's a different thing, because if it expires fully in the money, meaning the price is over here, both legs are in the money, then you're going to be exercised on your long call, but you're going to be assigned on your short call. And at that point, you're going to be buying at this price and then selling the same thing at this price. You're just going to materialize the difference between strikes as a max value. So once you subtract the initial investment, you're going to have the max profit. So if it expires fully in the money, you're going to have a max profit for that spread, but it's going to, instead of selling it in the market, you're going to have to go through the exercise and assignment process here. So you're going to be selling at this price at KS and buying at this price KL, because KL is lower than KS. You're going to be realizing this profit or this value in between the strikes. Once you subtract the initial investment, again, that's going to be your profit. So here's some of the advantages for the use of vertical debit spreads. And in particular, this one is a long call spread. And it is now that we're going to start using combinations of stock with options and combinations of options as well, you're going to see these ones are this in particular vertical debit spreads and vertical credit spreads, which we are going to take a look at later, are pretty much the bread and butter for most traders. These are used a lot. So it's important for you to understand how they work. The advantages for a long call spread or for vertical debit spreads in general is that you have a clear max profit and max loss. You have less time decay because the Greeks are partially offset, like we said. You have access to expensive underlyings, as we were mentioning, because now you only have to put up the amount that you need for that particular spread. You don't need to put up any additional capital. So even if it's a very expensive underlying, and let's say for example this is a $2,000 underlying, and the call is trading at $50, so you need to put up $5,000 to buy this call. If you don't have that money, well, what you could do is you could buy a spread that's, for example, the 2005 for, let's say, $2, because now the spread can only take its values from 0 to the width of the spread. That's it, from 0. So if you have a $5 wide spread, then the value of the spread can only be from 0 to 5. That's it. So you are certain that you're going to be putting up only less than $500 in this case for one single contract, whereas otherwise you would have to come up with at least $5,000 because that call is going to be trading at $50, for example. Also, there's no need for the highest level of approval for options trading. So you don't need to, because you're not selling anything naked. You don't need the highest level of approval. It's good to have anyway, but if you don't have it, there's a very high possibility that that you are going to be allowed to put on debit spreads. Now let's take a look at the same thing on the put side, and I'm going to be going a little bit faster because it's the same thing as with a call spread, but on the other side. So with a long put, you have a long put here, you buy it, you pay this money, and it can go to 0. So this is not unlimited, but it's very large, all the way to 0. You can profit on the downside. Okay, this is a long put. You pay the whatever premium that the put is trading at. You have a short put, which is the opposite. You sell it here, you keep the credit, and if it expires out of the money, you get to keep it, and then you start losing once you go, once you cross the strike price and it starts going lower in the underlying price. You're going to be losing money on the downside. Okay, so if you combine these two elements, now you're going to have a long put here and a short put here, and the graph is going to be something like this. Now, instead of having such a large initial investment, it's going to be partially offset with the credit from the put that you sell, and you have a long put here and a short put here. So let's go through it very quickly. The structure is long one out of the money put at KL, so long this put, short another put at a lower price. And keep in mind, these have to be in the same expiration, same number of contracts. So long this put, short this put at KL, at KS. The initial investment is going to be the cost of the put that you're long minus the cost of the put that you're short, because you're going to be receiving it as credit. So that's going to be your max loss. So with a vertical spread, the money that you can lose is not only predefined, but it's whatever it is you paid for the spread that you bought. So in this case, PL minus PS, that's your max loss. That's your initial investment. And that is going to be a part of your max profit. Your max profit is going to be the same. The difference in strikes, because this is how much this spread can expand to. This is the max value, the difference in strikes, KL minus KS, and then you subtract whatever it is you paid for that spread. The break even is going to be at the strike price where you bought the put minus whatever you paid for for the spread. So this distance, PL minus PS. Again, this is going to be the profit and loss line at expiration, and you're going to have a T plus 1 line at any time prior to expiration, and this is going to be approaching the expiration solid line. Something similar to what we saw for the call spread, for the long call spread. They're initiated for a debit on a single transaction, same expiration, same number of contracts. This is a bearish position. The price is here, and you want the price to go lower for you to profit in this strategy. These are closed with a sell to close order on a single transaction, same thing. The Greeks will be partially offset because of both legs. At expiration, if it expires out of the money, it's going to expire worthless. So right here, if it expires at the money, which is at any point between KL and KS, you're going to be exercised on your long put. So if you have the stock, you're going to be selling it at this price. If you don't have the stock, then you're going to have a short position in the stock initiated for you. So be aware of this, because if it expires at the money, so in between these two strikes, you're at risk of being initiated a short position on the underlying. Now, keep in mind the price is lower now because it expired here, so you might just take whatever short position and close it here, realizing a profit, but you're going to be taking on the risk during that weekend, and something could happen. Maybe the stock starts going higher, and then you're going to lose whatever profit you made on the actual vertical spread. So always try to close your spreads prior to expiration to avoid these kinds of surprises. So if it expires in the money, then you're going to be exercised here, and then you're going to be assigned here. So you're going to, same as with calls, you're gonna realize the profit between the strike prices minus the investment, that the original debit that you paid for this spread. Same advantages as the call spread. There's a clear max profit and max loss. You can see it here. Less time decay because there's now they're going to be partially offset. You have access to expensive underlyings. Also, in the case of puts in particular, sometimes it's not so easy to short a stock. There is an uptick rule, and there is a locate that needs to happen prior to you initiating a short position on a stock. So this might be a very easy way to take a bearish position on a stock without having to going through the shorting process. And also, there is no need for the highest level of approval for options trading because everything is clearly defined. Max loss, max profit. You only need the money. You only need the money where you bought the spread, and the most you can lose is what you paid for it. And you can go, your profits can go all the way up to the width of the strikes or the width of the spread minus your initial debit. Now let's take a look at an example for a long call spread. We have a stock that's trading at $2,000, and we have a call at the 2100 strike price, which is trading at $50, and we have another call at the $2,105, so $5 higher than the previous one. That's trading at $48. So stock's trading at 2,000, and I'm going to buy the 2100 call, and then I'm going to sell the 2105 call. Okay, so I'm going to be buying the 2105 long call spread initiated for $2, 50 minus 48. I have to pay 50 and receive 48, so a total of $200. There is no additional buying power reduction. Okay, because I'm buying the spread, and it can only go higher. It cannot go lower. It cannot take on negative values. The worst that can happen is that it expires worthless. Max profit is going to be $300 because it's going to be the width of the spread, which is $5, minus whatever I paid for it, which is $2. So it's going to be a max profit of 3 times 100 shares per contract. It's going to be $300, max loss $200. Clearly defined. The break even is $2,102 because we have the 2 that we paid for this, and I have to be in the money at least by that amount before I start making money. So break even, $2,102. Now let's think about this and analyze the capital that's required to take positions on this imaginary, fictitious underlying. The capital required to buy 100 shares would be 2,000 times 100, so $200,000. If I just want to buy one 2100 call, I need to come up with $5,000 because it's 50 times 100 shares per contract. And if I want to buy the 2105 call spread, I have to come up with $200. So see the difference here. In all these situations, we're taking on a bullish position. Of course, if you buy the shares, you're going to start profiting right away if it starts going up. But also, you're going to start losing a lot of money, and potentially you could lose all the way to zero if it starts going down. So it's a different configuration, but just in terms of taking on a bullish position, you can see how effective and how efficient a long call spread is at using capital. Now we're going to see the same thing on the other side. We're going to talk about a put spread. We're going to do something similar. We have a stock that's trading at $1,600. We have the 1505 strike price for the put trading at $35. And then we have the $1,500 strike price for the short put that's trading at $33. So with this configuration, we're going to be buying the 1505 1500 long put spread initiated for $2, so 35 minus 33 for a total of $200 because it's 100 shares per contract, and I'm not going to be needing any additional BPR. So I don't need any additional capital. I'm going to be paying $200, and that's the most I can lose. I don't need to put up any additional capital. The rest of my portfolio I can deploy somewhere else. Max profit is going to be 300. So the difference in strikes, 1505 minus 1500 minus what we paid for it, $2. So 5 minus 2, 3. And 100 shares per contract, $300. Break even is going to be 1503. Why? This is going to be 1505, and then I need to go below this price by at least the amount that I already paid for this spread. So $2, 1505 minus 2, 1503. That's going to be my break even. Capital required, something similar. If I want to short 100 shares, this is going to be 1600 times 100 shares. It's going to be $160,000. If I want to buy a single 1505 put, I'm going to have to put up $3,500. And if I just want to buy the 1505 $1,500 put spread, I'm going to have to come up with $200 to carry this position. So it's, again, a very efficient use of capital. Now notice something here. It doesn't matter that the price goes very low. I'm still going to be making my max profit, not anymore. And it doesn't matter that it goes very high because I'm going to be suffering my max loss and not anymore. However, prior to expiration, this dashed line is going to be representing our current P&L. And if you see here, if the price goes very low, then still you're not going to go over your max profit, but the max profit is going to be available to you because otherwise, you have to wait until expiration to get the full value of your spread. But if the price is sufficiently low, then it's going to be very, very close. Because of this, you might be able to take it off prior to expiration. So in a way, at a time that's prior to expiration, you are interested in the price going your way, even though it might be already at a point where if it expired there, it would be max profit. Why? Because it's going to allow you to take off your position prior to expiration. Now let's go to the platform and take a look at some examples there. So we're on a trading platform now, and we're going to take a look at an example. We're going to pick an expensive underlying so we can see the advantages of using vertical spreads. And I'm going to be taking a look at Amazon. Amazon's trading at $2,497, so very close to $2,500. And I'm going to be opening up here the June 2020 expiration, 30 days to go. Okay, we're here at 2,500 is pretty much the at the money. So what I'm going to be doing is I'm going to be buying a call spread, and I'm going to pick the let's say the 41 delta strike price for the call. So it's going to be the 25.50 strike price. Okay, and I'm going to go and do it. I'm going to do it the long way. Usually I would just click on the ask or click on the bid, but I'm going to be using the actual menu options in this case to initiate the vertical spread. Okay, so I'm going to be going here, buy, vertical. Okay, and it's going to pick the next one, the next strike price, and in this case, this is the one that I want to buy. So this is good. So here, let's analyze this. We're buying. So a vertical, one contract of Amazon, and it's the June 2020 expiration, 25.50, 25.60. This spread can only go to 10. So our max profit is going to be 10 minus 355 in this case, which is what we're paying for this spread. So if we open it up here, we can see this is the order. We already went through that. The max profit is $645. So $10 minus 355 multiplied by $100 by 100 shares per contract. Okay. The break even is going to be 25.50. So the long call strike price plus what we paid for it. So $2,553.55 is going to be the break even. Max loss is going to be 355, which is the total cost, the total money that we put up for this particular trade. The buying power effect is going to be 355. So this is all that we're going to be using from our portfolio, nothing in addition to this. And now what we're going to do is we're going to analyze the trade. Okay. And we're going to put this aside for a while. And what I'm going to do is I'm going to go back and I'm going to be buying a long put spread. Now I'm going to use pretty much the same delta. So 24.50 here. And I'm going to be doing the same. Buy, vertical. Okay, didn't pick it up. Buy, vertical. And here we have it. So we have a vertical spread that we're buying. One, June 2020, 24.50, 24.45. I'm going to make it $10 wide in this case. So 24.50, 24.40. So we have something similar to the one we did for the call. 24.50, 24.40, the put. Trading for 418. So same thing. Max loss is going to be 418 times 100, $418. Max profit is going to be the width of the spread. So $10 multiplied by 100 shares per contract. It's going to be 1,000 minus 418. We're going to have $582 in max profit. And that's the 418 that we pay is the only amount of money that we have to have in order to initiate this trade. It's never going to change. This is the max loss. we can't lose any more than this. And this is why this is such an efficient use of capital with vertical spreads. So what I'm going to do now is I'm going to send this to the analyze page so that we can take a look now at these two positions. So let's analyze. Let's open up the pricing here. Okay, so we have on the top, we have the long call spread, and on the bottom, we have the long put spread. So as we said, here is the price right now. The purple line is the P&L today. So if today the price were to go very high, you're going to be making this amount of money shown by the purple line. If we analyze the put side, here's where the price is. The purple line is going to be the P&L today. And so if the price starts going higher, you're going to start making this much money. And then it's going to be capped in terms of profits at the blue line, which is the expiration line. Okay. So let's go back. This is the long call spread. What I'm going to do is the purple line is today. This is where the price is. This is the max amount of money that I can make, which is at this point 642, because it's at 1,000 minus whatever it is. The price is changing because we're in the middle of market hours. Okay, so what I'm going to do is, now you can see that if price starts going up, you're going to start making money, but not the full amount, because you need to go to expiration to have that, which is what I was mentioning before. Now, if the price goes really, really high, a lot higher than your short, so remember, here we are long the 2550, which is this one, and short the 2560, which is this one. So if it goes much higher than 2560, then it's going to be approaching the expiration line. Okay, so at this point, there's only a few dollars remain to be made. So at that point, you might be considering to take it off. Take that position off and redeploy somewhere else. Okay, now I'm going to simulate time passing. Look at the purple line. This is the important thing here. So still we're doing the long call spread. Look at the purple line. Okay, as time passes, that purple line is going to start getting closer and closer to the actual expiration line until it actually expires right there. Okay, let's take a look at the put now. On the put side, same thing. Here's where the price is. This is the purple line representing the P&L today. Now, if time starts passing, the line is going to approach the expiration line until it merges with it. Okay, so for the long put spread, I can make up to 582 because it's currently trading at 418. So look at this and notice how little money I have to put up here. $363, $408. Okay, what if I want to buy 100 shares of Amazon? Okay, because I'm going to simulate taking the same number of shares. Remember, one call contract or put contract is covering 100 shares. Okay, so let's say I buy 100 shares of Amazon. Okay, I need, the cost of the trade is going to be $249,000. Of course, because I have margin, I only need to put up half of that position. But still, we're talking about $125,000. Instead of this, to take a long position, I'm putting up $360. So it's a big difference. We're still long Amazon. Of course, on the one hand, with the stock, you start making money right away, but you also can lose a lot of money because you're totally exposed on the downside. In this case, I can only lose the $350 that I'm paying here. Okay, so that's another advantage. Your loss is limited, and so are your profits. So if Amazon starts going on a tear, then you're going to be making more money if you had the stock, of course, but you're also exposed on the downside. And plus, you need to put up $125,000 if you have margin. So this is another cost of using the underlying directly instead of using options, and in particular using a long call spread. In this case, if I'm bullish, or so this one if I'm bullish, and a long put spread if I'm bearish. Also, just remember that you can also buy this call on its own, the 225.50 call, for example. So in that case, you would need to pay $5,470. And for options, there is no margin. So you have to pay $5,470. By making this into a spread, you don't have to put up $125,000 for the stock or $5,400 for the single call, but you are only paying $360, and you're taking a bullish position, which is probably what you originally intended. So I hope that this was clear. It is not very complex, but we're starting to deal with multiple legs in a single strategy. So it might get a little bit confusing at the beginning. Later on, it's going to be second nature. You're not even going to think about this. So these were debit spreads. Later on, we're going to be talking about credit spreads, and they're very similar. However, one is the opposite of the other one. So now that you have this tool in your arsenal, you're going to be able to go out and put on more strategic and more intelligent and more efficient trades using options. Thank you very much for your attention, and goodbye.